You are listening to The Intellectual Investor, episode number 88, Accent Podcast Interview, Part 1. To listen to more episodes, visit investor.fm. To learn more about Vitaly's investing firm, IMA, go to imausa.com. Accent Podcast Interview, Part 1. In November 2019, I had the pleasure to sit down with Aznor Midov, fellow Russian immigrant and host of the Accent podcast, to talk about my story and lessons I've learned from 20 years of investing. In part 1 of a 2-part podcast, I share my thoughts on how value investing has evolved, the difference between value and growth at a reasonable price, the role of diversification and rebalancing, and how I find new stock ideas. Enjoy.
Hello and welcome to the Accent Podcast, where I, Aznor Midov, interview accomplished investors, entrepreneurs, business and thought leaders about their personal and professional journeys. In this episode, I sit down with a famous value investor, Vitaly Katsenelson, who is the CEO and a Chief Investment Officer of Investment Management Associates. Vitaly has written several books on investing and is a frequent speaker at the industry events. We spoke about value investing, his stock picking process, his biggest mistakes, his bucket list, and many other things. I'll let you listen for yourself. Vitaly, thanks very much for being on the podcast.
It's my pleasure.
Let's start with a quick introduction of Vitaly Katsenelson.
I came from Russia in 1991. I was 18 years old, and I basically spent my whole adult American life in Denver. I graduated from University of Colorado, Denver, got my undergraduate degree in finance and then a graduate degree in finance, and then I got my CFA. And I've been basically investing since 1997. I've been with IMA from 1997. And the way I look myself is kind of a die-hard value investor. And I'm also the guy who thinks through writing. That's why you get to see some of my stuff in the internet, because that's how I think. Some people think you can think very well by talking to others. And I do that somewhat, but most of the time, I get most of my ideas, my best thoughts, when I'm sitting in the early morning in a dark room with my headphones on and just basically just stare at the screen and listen to music and write.
And you invest on behalf of Investment Management Associates, right?
Yeah, so I'm a partner at IMA, and I have a partner, Mike. IMA's clients are basically high net worth individuals who want to grow their wealth but don't want to worry about the markets. So these are our clients.
And what's your role at IMA?
I'm a CIO and CEO and a portfolio manager.
So you run the company, let's just say that.
Yes, with help of very capable other people here, but I try.
Vitaly, you mentioned that you are a value investor. Can you define value investing for people who are not familiar with the term?
So value investing is one of those very confusing terms, because when I say value investing, when I'm a value investor, the first, if you had to describe it with one word, what do you think it would be?
Okay.
Cheap, right? Yeah. So it's cheap. Well, to me, that's an incredible oversimplification of what value investing is. To me, value investing is basically philosophy. And it's a philosophy because it's a way of thinking about investing. It's more than just buying cheap stocks. It's really the way of thinking about investing in general. And at the core of that philosophy, basically what I call the 6 commandments, that Ben Graham described in his book, The Intelligent Investor, which is basically, if I remember all of them, but the number 1 would be, you look at stocks not as pieces of paper but as businesses. The stock market is there to serve you, not the other way around. True risk is not volatility, but permanent loss of capital. And the list goes on. So, and by the way, let me do an infomercial. I have a kind of a podcast, which is, where the very, very first episode of the podcast is basically takes you through all the 6 commandments about investing. So if you go to investor.fm and listen to it, there's a 25-minute podcast, which is the excerpt from my next book, hopefully, when I finish it, and it walks you through that.
So how is it different from other types of investing?
Warren Buffett says that basically the word value investing is a little bit redundant, it's because it should be just investing, because it's a commonsensical way to invest. Everything else is basically kind of different shades of it. Nobody goes into stock market say, I want to buy companies that are overvalued and I want to look for another fool to buy it at a higher price. That's basically looking at the stock market as a casino at your fingertip. It's really looking at treating stocks as gambling. People do that, but it's really not investing. It's something else. When you do this, you're trying to find some kind of order in a very random environment. And so some people do that, and that's fine, but that's not investing. Just let's be clear about that. That is more systematized version of gambling, or
How did you discover value investing, and why did it click? Because I don't think they teach it in CFA.
I came to value investing not right away. In fact, so when I joined IMA was a kind of growth at reasonable price. It was started by Mike Kahn, who is my partner now. And Mike has done a phenomenal job running the firm, had a phenomenal track record, but it was a growth at reasonable price. And what I realized, and that strategy has worked well for a long time, except after the dot-com bubble blew up, we actually, as a firm, have done very well because we were not playing the dot-com bubble game. But year after that, we started to struggle. We had a few years which were kind of difficult. And I was trying to figure out why. And what I realized that we owned kind of high-quality companies that were real businesses. But what happened to them was they basically were fully valued when we owned them. This is when I realized when you own stocks, you really want to have margin of safety. And this realization that you need to have margin of safety, that turned me into value investor.
How is it different from GARP? Because if you look at Buffett, somebody would argue that he actually uses a growth at a reasonable price. Would you agree with that?
Okay, this is where it gets more complicated because I think there is a value in growth. And so when Warren Buffett was buying Coke, for instance, in the 80s, it may not have passed Ben Graham's screens of cheap stock. It was because it was not statistically cheap. But what Buffett saw at the time is that the Coke had a huge growth runway ahead of it. And therefore, if you looked at Coke from perspective of earnings 5 years out or 10 years out, actually it was an inexpensive stock. So the difference between value investing and GARP, I guess what you put your emphasis on. And I'm not going to profess that I'm a huge expert on GARP investing. Like today, I don't even distinguish difference between GARP and growth because I do own companies today that are what's considered to be GARP companies. Except if I look at earnings, 5 years out, then this companies actually look significantly undervalued. So I'm almost like everything we do, we try to kill the business and we look for margin of safety first. We ask ourselves a question: is it a high quality business? If the answer is yes, then we ask ourselves, do we understand the business? If the answer is yes, then we say, well, what is it worth? And then we look at the price to what it's worth, and then that drives our decision.
What's your take on diversification versus concentration?
I look at it from the two extremes. Okay, so on one side, when you are over-diversified, when you have hundreds and hundreds of stocks in your portfolio, let's say you have 200 stocks, so average position is going to be 50 basis points. So if you've done this incredible research, the company in your portfolio doubles, so your portfolio goes up by 50 basis points. So it's a lot of work for very little. So that's the problem. Is kind of over diversification on one side. Also, another problem is it's incredibly difficult to do thorough research on the portfolio of 200 stocks. So that's another problem with that. Then let's take it to another extreme when you say you have a portfolio of 2 stocks. And you're probably going to know a lot more about these 2 stocks than the portfolio manager on another extreme would know about 200. This is great. But the problem is, if you're wrong, or even if you're not wrong, but just some randomness happens, some black swan hits you, and one of your stock declines 50%, now your portfolio is down 25%. So when you are under-diversified, the cost of being wrong is too high. As an investor, what I try to do, you try to find a medium that where every decision you do matters, but when the cost of being wrong is not too high, and this number is going to be different from one investor to another. This is 10, 15 years ago, I was at a conference, and I was talking to Monish Pabrai, and I think Monish had at the time maybe 6 stocks or 10 stocks, I forget. And I asked him, how can you handle such a concentration? And he says, don't look at me, look at this guy, and he only has 3 stocks. So it's going to be different from one person to another. And one other point, and this is very important, your diversification or concentration level, however you wanted to express it, is really should fit to your personality.
Mm-hmm.
So if I own 200 stocks, it would drive me crazy because I would know nothing about them. And if I own 2 stocks, I would not be able to sleep at night.
Yeah.
So for us, we usually own 20 to 30 stocks, maybe 20, 25 stocks. Average position size, we aim for 5%, and it's going to range from 3 to 7. And with this kind of concentration, I can sleep well at night.
When one of your companies grows to, let's say, 5, 10, 20%, at what point do you start rebalancing?
It's a good question. To some degree, it's usually happens when when the company appreciates a lot. It's relation to fair value, and it's depending on the company. This is going to be dependent on the company. So it's almost like there are 2 questions in it. One is, what's your sell discipline? Let me answer the question that I'm going to ask myself. What is my sell discipline in this case? When I own a company, it's a slow growing company, I'm going to be a lot more aggressive with my selling.
Mm-hmm.
When I own a company that is a fast grower, I'm going to have a much longer sales leash. So like, I'll give you an example. I'm going to make up 2 companies. Actually, we own both. But let's say McKesson versus Twilio. Twilio is been growing, 30 to 50% a year.
Wait, you own Twilio?
Yes, I know. So you're going to lose respect from me after this.
No, I'm not. It's actually... I mean, I don't want to interrupt you, but I'm sorry, go on.
Well, so let me finish this so we can go back to Twilio if you want. So Twilio is growing so fast that our sales leash on Twilio is much longer. So we would be trimming, when it got to be a very large part of our portfolio, I would sell 10, 20% of it like every few months because it kept going up. With McKesson, let's see if it's worth $250, it would be probably sell one half around $230, another half now $270 or something. So it's a much shorter, more narrow range of selling. So that's basically most likely how we're going to control position size in this case. Yeah.
Back to Twilio.
Yes.
What attracted you in Twilio? And obviously it's not very value investish stock based of traditional understanding of value investing by institutional investors, I'd say.
Yeah, so this is why I struggle with the whole thing. Like when I say value investing is on cheap stocks, cheap based on what? Like you can have a company that's a Molson Ice Cube that's trading at 10 times earnings, and that's overvalued. So a while back, I realized that we want to have a portfolio that's not just full of ice cubes, melting ice cubes.
Yeah.
Okay, so we did a couple of things for that. Number one, we said we want to own high quality. And if the company does not pass our quality test, we stop. So our analysis stops and we move on. Okay. Second thing we did, we wanted to introduce growth elements. So in other words, when I say growth, I mean companies that that are growing earnings and paying dividends.
Mm-hmm.
Sometimes it's both. Sometimes it's just one. Sometimes it's the other one. How do you deal with that? So we did an interesting trick. When we remember I told you how when we value companies, we look 4 to 5 years out. So we figure out what the company is worth 4 or 5 years out, and then figure out how much we want to pay for this company today.
Mm-hmm.
If you do this with a company that's not growing earnings, you need to have a much greater discount to its fair value for it to make it into our portfolio because time is not on your side. If you think about it, right? If company is worth $100 4 years from now and it's not growing, its value today is still going to be $100 as well, right? So the value doesn't change. So therefore, I need to have a much greater discount to its fair value for it to make it to our portfolio. Now, if I own a company that's growing earnings substantially, its value going to rise over time as well. And therefore, if I look 4 years out and I find the earnings have tripled, then the company is worth a lot more. So therefore, from that price, I discount it today, and that gives us a buy price. So the question becomes, how did Twilio make it into our portfolio? Because it really has no earnings yet. And the way we looked at it, when we bought it, and this was late, 2017, early 2018, the stock completely annihilated. And I figured out if their growth rate declines from 50% what it was growing then to 20, 3 years out, we'll be paying 2 times revenues.
Mm.
And on the 2 times revenues, that's basically most of software companies don't ever trade at less than 2 times revenues.
Oh, no, never. No.
Yeah, so exactly. So that was kind of our margin of safety. But also one important element to me was that at the time when we looked at Twilio, we realized they're kind of the Google of smart communications. And what I also realized that they had a founder who really wanted the company to succeed. So you had that going for them. And the reason they were not profitable was because they were spending $150 million on R&D. So if you look at R&D and you say, well, if they cut R&D from $150 million to 20, okay, and the competitors were spending like $1 million or $2 million, okay, what would the earnings power be? So once you start looking at it this way and you start treating R&D as almost like capital expenditures, then you realize actually it wasn't that expensive. So, but you had to look at it from a very different perspective. So because it had margin of safety, I figured in the worst case, we're not going to make money. So it kind of, you can see how you can take a company like Twilio and still fits into our investment framework.
What's your investment process like? How do you find the stocks you're interested in and what do you look at?
So it's a great question. So the stock discovery process is very random. It's not like I open Forbes magazine on page 15, that's where I find my ideas. That's not how it works, right? It's basically, you want to expose yourself to randomness. So you want to expose yourself to that you know that idea is going to come from very random places. And I probably spent maybe 6 months to a year looking at Twilio before I had an insight, that aha moment where I realized, oh, really, this is not really a communications company. This is really a software company. Once I started looking at it that way, this is when the light went on. So, but basically we do screens, we talk to other value investors, and I have a significant network of other like-minded value investors I talk to all the time. I'm a member of Value Investor Club, so I get ideas there. We read a lot. So ideas come from very random places, but once idea comes to us, we say, okay, well, is it a quality business? Do we understand it, what it's worth? Do we have this little insight, something that gave me different perspective from everybody else? Long time ago, we used to own Apple. And I think we bought it, I forget, 2012 or something. And the time it was like one of the most hated stocks on Wall Street. And my variant perception was that on Apple, that it's not a hardware company. It's more of a software company. Once you buy an iPhone, 9 out of 10 people are not going to switch to Android. And that means every 2 or 3 years, you're going to buy another iPhone.
Mm-hmm, yeah.
So there is a built-in recurrence of revenues. And once you have that insight, it's a lot easier to buy Apple when everybody hates it. So you look for this insight. I cannot tell you how many companies I look at. I have no insight and I just move on.
What did you learn from your biggest winners and from your biggest losers? And do you remember them very well?
Yes. Actually, it's kind of interesting. You were there when, so my biggest loser actually is not the company that I lost money on, it's the company I did not make as much money on. And you were there. So
Electronic Arts? Electronic Arts?
Yes. Yeah, Electronic. So I don't know if
still blown away. Yeah, I remember. Like, I actually going to tell the story.
Well, go ahead.
So back, and I think it was 2012, yeah. So we hosted a Value Investing seminar at San Francisco State University, and you were one of the 5 speakers. And what's amazing to me, like with value investors, is very humble group of people in general. You're all very successful, yet I reached out to you, and you didn't know who I was at least, right? And you just flew to San Francisco, and you spoke about your favorite stock to students we've never met. And that was Electronic Arts. And I don't remember how many X's were your returns, but I do remember looking back and thinking, holy cow, I wish I had listened to Vitaly and bought this stock. What was the return on that? Do you remember?
Well, yeah, very vividly. And so this is where the failures come in. So when somebody asks you this question, what's your biggest failures? Like, you usually think about the company you bought and the stock decline you lost money on, right? But in the worst case, you can only lose 100%. Mm-hmm. This one, I lost a lot more. And here's why. Mm-hmm. So we bought Electronic Arts at, I think, $16. It declined to 13. And when I was at that conference, if you look at the stock price, I think it was 10 or 11. And so just realized at that time I was already down 40% on the stock. And, and every single news, I remember the presentation vividly because every single news that came out about electronic cars, it was actually for 2 years in a row, there's some kind of magazine, the company was listed as the worst company of the year. And the year, 2 years before that, BP was and the year before that was I don't know, Philip Morris or something. So this a consumerist magazine. And so it was a really hated stock. And my insight at the time was that basically there was a transition from packaged software to download software. And when this transition happens, the revenues don't show that, but the margins do. And once this transition happens, the margins will skyrocket. Plus cell phones and etc. It's a basic gaming device in our pockets, right? And anyway, long story short, so the owning electronic cars for a year was a very painful experience because we lost money, from $16 to $10, which is but more, and still lost money. And what happens during to you at this time is that this self-doubt starts to kick in. So I remember vividly when I was doing a presentation, how painful it was for me to make this presentation because I knew that my analysis was right, but it was still so painful because we were losing money on the stock. And then the stock doubles, I celebrate, and I sell. So we double the money. Except then it goes and doubles 2 more times, so it's quadruples. So when you ask me about my mistakes, we made $15, and I may have left another $90 on the table, basically.
90?
Well, because it went to 120.
Oh my God.
So
I knew it's a multi-bagger. I didn't realize that it made more than 10x. Oh.
So let me tell you what I learned from this.
Thank you for listening. This and other investment articles by Vitaly Katsenelson are based on value investing principles that were first brought down from the mountain by Benjamin Graham and later were popularized by Warren Buffett. To learn more about these principles, visit investor.fm and listen to the first episode of this podcast, titled The 6 Commandments of Value Investing. To learn more about how Vitaly's investment firm uses these principles to create low-risk, long-term oriented portfolios, visit imausa.com. Enjoy life and prosper.